It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. With me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Every tax season, before you file your tax returns, we want you to answer 3 specific tax planning questions. These are questions that are going to help you get your tax return right, get it filed correctly, but also set you on the right path for planning in the year to come. So today, on today's episodes, we're going to share with you those questions and some unique or custom planning opportunities for you in your tax picture.
That's right. If you have a question for the program, we'd love to hear from you. If you need any help, we're here as well. Call or text us, 574-222-2000. That's 574-222-2000. All over, online, wisemoneyshow.com is where you can find us, and then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Tax planning is one of the 6 areas of your financial life. It's not just this separate thing that's required once a year by April 15. That's tax preparation. Tax planning is the creative. That's the proactive. That's the fun. That's that's looking for opportunities. Tax preparation is different. Guys, let's break down the two.
Yeah, you know, when I think of tax planning, I think of how do you change or optimize the methods that you're using to go achieve the financial goals in your life in a way that helps you be efficient from a tax standpoint. So you may already want to be saving for retirement or accumulate money to help your kids with college someday. But what's the best way to do that helps you from a tax standpoint also? Think methods and a lot of the tax strategies that we utilize over time are found in other areas of your financial life because tax planning is something that you weave throughout the entire financial plan.
Yeah, I think in terms, I like the word you use, optimize. And I think, because a lot of times when we're meeting with folks and we say, who helps you with your tax planning? And they will think, and then they'll start to answer, and then they'll say, well, I mean, really no one. Right. Because the question is, who's looking out for you? And so when you say tax planning, I think of the creative side, and you say tax preparation, I think of compliance. Mm-hmm. I need to comply with the existing tax code and tax laws of the country and the state in which I live, and make sure that the tax return that I file is compliant.
Yeah, and it's accurate, and it's a depiction of what actually occurred, mm-hmm. right? But the tax planning is where you decide what's going to occur. Mm-hmm. You use your influence and your options available in your financial life to pick those the tax picture that ultimately is best for you. And then, yes, let's get the tax return prepared correctly.
Yeah, I also think proactive opportunities versus reactive, just getting the right number in the right box. I also think, and you've heard us say this many times before, tax planning is all about paying the least amount of tax over your lifetime, if not multiple lifetimes. It's also about avoiding surprises. So tax planning and tax preparation are related. They are not the same thing. Where they meet, tax planning and tax preparation, is these 3 questions that you need to answer. And Josh teed it up. We've done some shows on this before, but it's that important. Every year, as you're getting your tax return done, you have to answer 3 questions. If you don't, you're not going to have confidence that your return is compliant, mm-hmm. and that you're taking advantage of all the opportunities this year and beyond. So you have to answer these questions. This is where tax planning and tax preparation meets. Question number 1 is, do I understand why my return turned out the way that it did? This mm-hmm. is, again, you've got your return done, but you haven't filed it yet. So you can see, all right, how's it looking? And you might say, that sounds terrible. And I would agree with you. However, you need to have someone in your life that is geeky and likes that sort of stuff. And here's why that's important. Did you get all the deductions that you were entitled to? Did you miss something? That sort of double check of confirmation of, yeah, I see how this is all playing out. It doesn't need to be that mysterious. And you don't need to be a tax expert either, but someone just holding up the mirror saying, here's your return. Even comparing it to last year, does this look right? Do you have everything captured here?
This is part of the reason why having a professional in your life who can be that sounding board, or you said hold the mirror up to you and say, hey, is this accurate? Is it correct as we're looking at your tax return? It's good to sit down with somebody after that return is drafted, but not yet filed. It's your opportunity to, yes, check it for accuracy and hopefully check it against the game plan that you were already pursuing last year.
Right.
You know, if you can do a side-by-side comparison between the tax projection work that you did in the fall, and that was sort of a mock version of the tax return based on how you were trying to influence the tax return to look. Now we've got actual numbers and all the statements have been generated and we've got real data in the tax return and it's drafted. Do they match? Does it make sense why there's discrepancies between what you thought was happening and what actually played out? So yes, it's quality control. It's also maybe an opportunity to celebrate that, yeah, I know exactly why my tax return looks that way because I made it look that way way back in the fall.
And you have to answer that first question because it then allows you to answer the better question, which is question number 2. Is there anything that I should be doing right now before I file this thing to improve this return? Is there, and that's the question we're going to help you answer with some creative ideas here in a second. But before April 15, before I file this return, is there anything I can do right now to improve it? Yeah, that's the creative work. That's the planning work. We're going to get in and share some ideas.
Yeah, sometimes we refer to this as kind of after the fact planning.
Yeah.
Because the year is already over. Most things are just kind of settled science. It is, chiseled into stone. What's done is done. The year is complete. But other areas of the tax laws allow you to still be utilizing some strategies. There's decisions you can make after the year has come and gone, but right up until the time that you either file the return or it's due.
All right, we're going to answer that here in just a minute. Let me just share the third question, though, then. After you know, yep, I can see where all these numbers are coming from. My tax return, for the most part, makes sense. I've then analyzed all of the opportunities that I could do right now to improve last year's return, and from a planning perspective, I've implemented the right ones. You then ask, what's changing in my financial life that either I need to start changing how I plan for this year ahead from a tax standpoint, or at least just be prepared. So what's changing in my tax picture now when you're still in the first quarter, when you've got a lot of the field still left in front of you? What's changing so that you can either adapt your plan or get prepared?
Yeah. We're telling you today that all 3 of these questions need to be asked every year when you're filing your taxes. But if I was laying these out, I would say they're good, better, best.
Yeah.
This third one is the most important one because it gives you the most influence on the years ahead. You have more of the calendar year. You have all strategies at your disposal still because we're still in 2025 now. And you've got a lot of time to be able to uncover and then implement the strategies that make sense for you.
Here's an example. Josh, do you have a kiddo turning 17 this year in 2025?
Sure do.
Do you have a kiddo turning 17 next year in 2026?
Doggone it.
And why is that important? And because the child tax credit, again, for whatever reason, it's the year you turn 7 or those kids turn 17 that thing goes away. And that's just one of the examples. Like let alone opportunities. You don't want to show up and say, oh, I got this $2,000 tax credit last year. It helped my refund, blah, blah, blah. It's going to be there next year. And then all of a sudden show up and it's only $500. That can move you, and we've seen it, move people from getting a refund, okay, I feel good, to owing $1,000. Mm-hmm. Oh, I feel terrible.
Yeah.
So.
Or do I have to pay back $10,000 of my advanced premium tax credit because I had an event that happened this year that goosed my income up a little bit, and now I'm over a threshold, and now I'm paying back all this money that I'd gotten in advance.
Yeah, the whole point here is we want to understand what has happened in the prior year, maybe even back a few years, but how is the year that we're in now and maybe the year to come, how are they going to be different? Because you have to be paying attention to those pivots, those changes in your financial life, because they can have, surprise implications in your tax picture.
No one likes tax surprises. Absolutely not. So, but that's question number 3. So those are the 3 questions that, and Josh said that you need to ask. You're right. And I've said that too. More importantly, no, you need to answer. Like you can ask those questions. You need to have great answers. And the great answers come from that collaborative work between your taxpayer, your CFP, and you. And that's how you really improve and optimize. We're going to answer question number 2. What are some things that you should have on your radar right now to improve last year's return before you file it? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning, and also on podcasts at the same time, but also on a couple of local radio stations as well. So yes, long form. It's lengthy, but it's broken up with segments because of the radio. We've got Next Wise Step videos that air all throughout the work week, though. In addition to this long form, those are more shorter form. We've got some YouTube shorts as well, some reels, whatever your taste buds are used to or prefer. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. If you like the content, leave comments and questions as well. All right.
All right.
Let's do it. I put bulleted list there. There might be more. I might be missing 1, 2, or whatever. But
Okay.
what should you have on a radar opportunities for last year before you file your return? Here we go. When you are filing your tax return this year, are you just like rushing through it and as soon as it's done, okay, print this thing, e-file, I'm out of here. What's my refund? Or can you pause? Take a breath before you file that thing and say, what could I do? What could I do to improve my return before I file it? That's tax planning. We're going to give you some ideas right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KF2 studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. And then all of our social media, wherever you're at, we are there as well. Search the Wise Money Show. We're answering the second tax planning question that you need to answer every year when you get your return done. Between January 1 and April 15, you actually can do some things, not a lot, but some, to improve last year's return. Guys, not to get, too philosophical, but you ever wonder? Like, I think this is a pretty underappreciated feature in the tax code. No one's ever, like, why do they even have this? And I'm not giving Congress too many pats on the back here, but I'll take this one. Yeah. I've always just taken it for granted. I did a video on the Wise Money YouTube channel recently where I was like, wait a second, why does this even exist? And it exists for opportunities for you to take a look at your return and say, oh, well, if it's going to look like this, maybe I could do that. Yeah. And so the question is, given that gift, given that opportunity, take advantage of it.
Yeah. And sometimes you don't even know if you are eligible until you have a draft of your tax return together, right? There may be certain thresholds of income that if you start to exceed them, some of the options start to go away or they change on you. And, once you have a draft of the return in place and it is crystal clear where you stand if you do nothing, now let's start to talk about those some things that are at your disposal. And a classic has always been, a lot of people will treat this as the time of year when they will contribute to a retirement account like a traditional IRA. Mm-hmm. A traditional IRA is a tool that can give you, as long as you're eligible, as long as your income stays low enough, you can get a tax deduction on this year's or on the tax return that you're filing. Even though the year is over, you can still contribute up until April 15th for the prior year. And it can be kind of game time decision, essentially. Sometimes being able to make that contribution to an IRA suddenly drops you down into a little bit lower tax bracket or a lower threshold of income, and maybe it suddenly opens up new tax benefits to you that you didn't even know were going to be available.
I'm gonna piggyback on what Kevin said earlier. Maybe he can just share it on like the main reason, but I'll just make a comment here, and I want to make it because I get teased on from you guys about the Roth. The traditional IRA gets no love. Like this thing, it almost feels like if you contribute to it, you're doing something wrong. And I'm going to tell you that's not true. Mm-hmm. It's an opportunity. So just because you haven't used the hammer much doesn't mean that it's a bad tool. You got to look at what's the job. And so to me, even though you might say, well, I can contribute to an IRA, a traditional IRA, or a Roth IRA. Oh, I love the Roth. Traditional, I don't want to get a tax benefit today and pay taxes later. Oh, why would I do that? And we actually have a question from a fan of the show asked that. Premium tax credits is one. Kevin, give an example.
Well, there are certain thresholds when you look at getting a health plan on the exchange, and you get it's priced based on your income. And so if your income is below a certain threshold, you could pay very little or you could pay nothing for your health plan. And you say, well, how am I paying nothing if the premium should be $1,000 a month and I'm paying $500? Well, the difference is made up from an advanced premium tax credit based on what your income is. You've claimed that your income will be. And if your income is different at the end of the year, then what you could end up doing is paying back all of the amount of the advanced premium tax credit that you received. So that's where I think of a couple. This is one of the areas where the traditional IRA, doing a pre-tax traditional IRA contribution, can help. That's one of the thresholds with my health insurance, but also with the retirement savers credit.
Yeah.
Like getting me below the threshold, bam, now I qualify for the retirement savers credit.
Yeah, that's right.
Or qualify for a slightly larger version of it because there's even bands within that tax benefit.
Right.
And this is something, if you're not familiar with the retirement savers credit, it's one of our favorites because you already need to be doing this type of saving for long-term goals like retirement anyway. But when the government will give you an incentive and put dollars right back on your tax return or back in your pocket, so to speak, just by doing what you ought to be doing anyway, it's pretty awesome.
Yeah.
But you go $1 too high on income, and all of a sudden it's out of reach.
Yep.
The traditional IRA is a way to put yourself right back down into the right category.
So what's the saying? Thumb your nose. Don't thumb your nose at the traditional IRA. It's a tool. It's a great tool, and I'm going to say, thank goodness for the opportunity to fund that thing for last year all the way up until April 15. So you can look at your return and say, I did not expect to have to repay those premium tax credits. Mm-hmm. We owe $4,000 on our tax return. That is a shock. Instead of having that $4,000 go to Uncle Sam, what if we put $6,000 into a pre-tax IRA? Now our income, modified adjusted gross income, is in line with what we projected, and I don't need to pay back that $4,000. So it's a very powerful thing.
You can really swing a tax return quickly when that's occurring, especially with the premium tax credits.
Yeah. So a couple points there with the traditional IRA. One is, if I have a retirement plan at work, can I still do a traditional IRA? And absolutely you can. Think two different pieces of the tax code, two different coupons, if you will. So you've got a retirement plan at work, and then you also have an IRA, and anyone can contribute to an IRA. Anyone can contribute to a traditional IRA. The question is,
as long as they have earned income.
Right.
That's the one catch. If you are retired and your only income that's rolling in is Social Security and maybe some rental or a pension or something, you didn't get, as I always say, paycheck money. Or profit from your own side hustle. That also can qualify. If you don't have that, then unfortunately you can't contribute.
Right. That goes without saying. So,
of course. So clear.
Yeah. So anyway, so if you have earned income and you can do before tax or after tax contributions to the traditional IRA, because if you have fantastic income above and beyond any kind of thresholds where you would get any kind of pre-tax benefit, you put the money into the traditional IRA after tax and turn around and convert that immediately to your Roth IRA. And now we're winning.
All right. The other one, obviously, the other side of that coin is contributing to a Roth IRA. Of course, you can do that up until April 15 for last year as well. Guys just did a review of a tax return for family that has said, hey, KFG, would love your help. Just prepare my taxes. I don't need your help yet with anything else. Well, individual, so married couple, 2 young kids, one income household, make about 120,000. So good income. $14,000 tax refund. The only thing is you're getting your $4,000 child tax credits, $2,000 for each of the kids. So in essence, they withheld $10,000 extra.
Way too much.
Forced savings. So here's the deal. I can't turn it off. So I'm reviewing the return, making sure it's accurate, blah, blah, blah. But I'm also thinking, what are they going to do with this money? Well, I mean, to me, if they contribute pre-tax, they wouldn't move into a lower tax bracket. They wouldn't get more credit. They wouldn't blah, blah, blah. So, and they're in a, okay tax bracket. Contribute that thing to the Roth.
Said Michael Paul.
Yeah.
Roth Bernard.
Take that $14,000. Now, I'm assuming it's forced savings. I'm assuming this is, there's a reason for this because it truly is just extra withholdings. It's not just credits that just fell out of the sky. It's extra withholdings. Well, forced savings for what? Might be for the new car, might be for the new couch, might be for the new TV, might be for something else. I would hope that a Roth IRA contribution's on that list. I would hope that you're looking and saying, what are the big financial priorities? What are the big financial goals with these dollars? Where should they best be directed? Mm-hmm. So anyway, so the Roth IRA in that situation could make a ton of sense where you all of a sudden have cash. And here's the thing. You can file the return saying, I will contribute to a Roth, then get your refund and use that refund money to contribute to the Roth for last year. So that's one of the ways to optimize. What are the other things that you could be doing? What are the other opportunities you can do to improve last year's tax picture before you file this year? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group.
It's a good story problem to, think through. Hey, what are all the different strategies that they could pursue in that case?
But here's this is the interesting thing to me. So I was just spending time with my favorite second lieutenant in the Marines. And so Josh and I were out there. It was a boys' weekend, and Caleb's friend Jonah came out, and Jonah was talking about his tax refund, and he said, "Well, I got a great tax refund last year," and he was talking about, "I have no idea what it's going to be this year," and I said, "Well, what adjustments did you make?" And he's like, "What do you mean?" And I said, "Well, did you change your W-4 at all to change your withholdings so that you'd have a different outcome?" And he said, "No, I didn't." And I said, "Well, it's likely then you're going to have a fatty this year as well." Yeah. But people don't fully understand what are the levers? How do I even do that? Like the folks that you were talking about who have an extra $800 a month. Because as I'm thinking about this, if I have an extra $800 a month withheld for taxes, yes, I could put it in the Roth. But what if I had some sort of revolving debt? That should be gone. Mm-hmm. What if I had a car payment at 7%? Gonzo. Keep on going down the line. Like, what are these things that I have that I've waited 12 months to even get my hands on that money? Mm-hmm. Like, I should not be waiting. I should have it dialed in, and I should know. All right. But this goes to point number 3.
Yep.
What changes are coming up?
Yep. All right. Ready?
No, dude. I got some words I want to get out.
Oh, that's good. Let's do them on
Save
the
them
air.
for the show.
Yeah. No, it's really good. I agree. All right. Third segment. Here we go. Are you eligible for a health savings account contribution? Do you have an HSA eligible high deductible health plan? If so, are you using it to its fullest potential? There's an opportunity for you before you file your return this year. We're helping with that right now. This is a Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Just search the Wise Money Show. Subscribe to it there. Rate the program there as well. That's helpful feedback for us and helps others that are looking for content on wise financial principles, helps them find us. So we appreciate that. You can share episodes on podcast as well. Talking about answering the second question of the 3 that you need to answer every time you get your return done. The first question is, do I understand why my return turned out the way that it did? you've gotten your return done, but you haven't filed it. You're holding up the mirror saying, do I get this? Is this right? Does this make sense? Because that allows you to answer then question number 2. Is there anything that I could be doing right now before I file to improve last year's return? And that's what the one that we're answering, but really quick. The third question then is, all right, now what's changed in my tax picture this year that I need to adapt my planning to? And Kevin, you're sharing some bonus content over the break about that. Because even the example we left off on, if you've got this extra $800 or so a month that's going to Uncle Sam, should that be an adjustment that you make right now at the beginning of the year to say, you know what? Maybe getting this really high refunds for the birds. Let's put ourselves in the safety zone, a couple $1,000 return or $1,000 return, and instead adjust our withholdings so that this money can go towards the credit card payment, can go towards the car payment, can go towards the 401k so we get the full company match or whatever it is. So
So you want to look and if you're in Indiana or Michigan, most state taxes are a lot like a flat tax. So most folks don't have a meaningful swing in, either a huge refund or owe a huge bunch of money to the state. It's on the federal side because of the gimmies and the gotchas that the IRS has on the federal side of life. And if you said, how do I do it? You need to fill out a W-4. And I would work with your HR department or your payroll department, or there's some department, and you might be the department yourself. Well, work on that to get the adjustments made so that the extra income, especially now. I mean, there were years where the money that I could put in the bank or anywhere else didn't really do much for me. So, what was the big deal about having a refund? It matters now. It's a big deal. So I would say understand what the levers are and how they work, and move those levers right now, and get them changed.
I like how you're essentially reframing the question, because we said that the third question you should not just ask but answer in your tax picture is, what can you do in the year ahead to improve your overall tax picture? But what you're saying, Kevin, is what if it's not necessarily an improvement on your tax picture, it's just an improvement on your financial life? Get that debt wiped out. Get that emergency fund built up.
Yes.
Whatever the next best thing is in your life that is on your radar, it's a goal that you're working towards, take that refund and get it applied there. Of course, today's episode is about us thinking, well, what impact can I have on the tax picture itself? And we have, there's a lot of people who they'll get to tax time, they'll have a draft of their tax return, and they will start asking, is there anything I can do for last year still to influence the tax picture? Is there anything I can be changing for the year to come? I'm even thinking of, we were talking in the last segment about how maybe you're deciding to fund a traditional IRA or a Roth IRA. Let's not lose sight of the fact that some people will do both.
Yeah.
There are some people who they intentionally kind of save up the money that they know they're going to be accumulating or contributing rather to retirement. They just don't know whether it's IRA or Roth until they do their tax return. And I've had some clients that they get very precise and they'll do a combination of the two. Maybe you're in a little bit higher tax bracket, but you're just barely into that tax bracket. A traditional IRA might drop your income back down, and now every dollar more that you save is in a low enough tax bracket that maybe you switch and you have those dollars contributed to a Roth. Like, you can actually get very, very precise in your contributions this way.
You're my people. Like that.
That's right.
I appreciate you. I appreciate you. I would say no one's ever done that by accident, though.
That's right.
So work with your CFP. All right, I teased out the HSA. That's another one.
Yeah.
Right? That's another one where you can contribute to the HSA for last year all the way up until April 15 this year. I think this one's an even bigger opportunity. I think this one's also really an area where people make a lot of mistakes.
Right, because a lot of times the question is, do I have an HSA? No, you have a high deductible health plan that is HSA eligible. So I've got two things. I've got my health plan, and it's HSA eligible. Okay, if it's HSA eligible, what would I do? And if I'm doing it for last year, one of the things that we see oftentimes is people will tell you, oh, I'm maxing out. I maxed out my HSA. And you look, and they're $1,000, $2,000, $3,000 short of the max.
How could that be? Because they change the rules every year, and it's like $50 increments.
Right.
I mean, pretty soon they're going to start like 50-cent increments. It's unbelievable. You can never remember.
Right. So this is where if you're not dialed in, and a lot of times, because there Mike, you said those are your people, the people that get really sharpen their pencil and do these things. But it's confusing because the best way to contribute to an HSA is via payroll deduction. There's some tax savings there. We won't go into that, but just trust me, that's the best way. But if I do that and I don't fully fill up the bucket, is it too late after 12/31? And it's not too late after December 31. I have up until my tax due deadline, which is April 15th, to make that contribution, and I can just write a check and to that. And there are some people that are actually prohibited from doing payroll deduction into an HSA, and so those people are doing a check anyway. And when I think about this, as I was listening to you, Joshua, talking about do I do the traditional or the Roth? Hey, the best way to do these things, if you can, is to fund them on a monthly basis. Yep. And so if you're prohibited from doing a payroll deduction into the HSA, make sure you're doing it on a monthly basis. But then when you get to the end, fill it up. And if you've got a spouse and you're both over 55, make sure both spouses are getting the $1,000 catch-up.
Yeah.
Mm-hmm.
And I don't know, who knows, someday there'll be the super HSA catch-up.
But here's a couple places where you could make a mistake. You could look at your HSA and say, well, the contribution limit, I contributed $1,000 less than that. And say, well, I'll fund extra. When, in fact, that $1,000 came from your employer. Mm-hmm. So what you're looking at is your W-2, what is it, box 12, box 13, box 14, can't remember. Don't have it right in front of me. But I know it's code W, and that shows both your contributions and your employer contributions, if you have one. They both count towards the match. Mm-hmm. This is not, or towards the maximum. That's not how your 401k works.
I know. Is that amazing?
It is.
I was just thinking about that because if you said I'm a logical person and I don't want to know everything, can you just make it make sense to me? No, it doesn't make sense.
So the question of, well, did you contribute the maximum? You might, if you look and say, no, I didn't. I can do a little bit more. Okay, no, but did the maximum get put in to your plan? So that's one mistake. Another mistake is you look and the cash banks are just a treat with this. Or even doing it online, because we're all afraid of people. We just would rather do it without talking to someone. Where you say, oh, I can make an extra contribution to my HSA to max it out before April 15. I'm going to just go to the bank and write a check and do it. Or I'm going to get online and I'm going to do it, and you make that contribution. Here's the problem. You never said whether that's for this year or last year, and the default is this year. Yeah. So then that is like, that's a tar baby. Like that thing, you get stuck in that thing. It's awful.
Getting that fix is tough.
Yeah.
And that is the tricky part about all of these ideas that we're sharing with you is you can contribute to an IRA, you can contribute to a Roth IRA. We're talking about an HSA now, but you're doing it for the prior year. You could also be doing it for the current year. Mm-hmm. And you have to be really specific on these details so that it gets coded properly, because all of these things are going to result in a report going to the IRS. And their records need to match your records when you go to file that return.
That's exactly right. Okay, so yeah, gosh, IRA, Roth IRA, HSA, and then we even answered a little bit of question number 3. There's still a few more things that you can do to improve last year's return before you file this year's return. We've got that and more coming up on the Wise Money Show with Korhorn Financial Group.
Okay, which one are we going into?
4th segment.
Is it really? Again?
Yeah. I don't know how you guys are missing this. This feels like an eternity to me.
Entirely.
I cannot wait till we're done. Good thing this is fun, because sorry, you two, I just want you to know, like, yeah, we're sick, so crummy.
And tired.
Mm-hmm.
Yeah, sick and tired.
And grouchy.
Yeah, that goes without saying.
All right, so 4th segment, I mean, if we get into listener questions, we will. It would be a quick one. But 529, SEP IRA, depreciation, if there's anything
Profit
else.
sharing.
Profit share. Yeah, absolutely. So, all right, last segment, land the plane. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the Wise Money YouTube channel. Go there, check it out, subscribe to it, turn on notifications so you're made aware, not only so that you're made aware every time we drop a new episode, talk show episode, long form like this, but every time we drop a Next Wise Step video that airs, honestly, we have one post every business day, Monday, Tuesday, Wednesday, Thursday, Friday, and taking financial concepts, applying it, explaining it, applying it from a planning perspective. It's not just information. It's how do you apply it? How do you take your next wise step in your financial life? So go to YouTube, search the Wise Money Show, subscribe to it there. All right. So what are some things as you're doing your tax return this year, before you file that thing, I could improve it. I could do something now before April 15. I can file my return saying I'm going to do this, and then before April 15, get it done to improve your return. Traditional IRA, Roth IRA, after tax, traditional IRA, HSA, Indiana 529 plan.
Yeah.
Talking to those of you Hoosiers that pay Indiana state tax. Okay, and I know we're speaking to people from all 50 states right now. Even sometimes people reach out from other countries, which I can imagine this has got to be super confusing to you. but in Indiana, and check your state as well, because a lot of states have this, but in Indiana a couple of years ago, they didn't really announce it. Like they need a new PR team over there. But your contribution, it used to be that it had to be done between 1/1 and 12/31. And there was always the hustle. And they always were like, hey, it's got to be postmarked by this. It's got to be in your account by this. You make sure. And then, like, in November, I think, late in the fall of 23, they just, by the way, this year you have up until April 15. Although there's some complexity with that. But funding your 529 plan for last year before April 15.
Yeah, it introduced some more flexibility just on the time horizon, but whether or not you should or can, that's specific to your situation, obviously. But man, we love the 529 plan. You talk about a way to very quickly have a meaningful impact on your tax picture for the prior year, or you could do it for this year as well. And in Indiana, if we can brag a little bit, what a fantastic savings plan for the college years or other educational needs, but we often think of these as college tools. You get a 20% credit, and it's on the first $7,500 that you contribute. And maybe you had already been contributing throughout last year and you qualified yourself for some of the maximum credit. 20% of whatever amount you contributed, it's already accounted for on the draft of your tax return. But what if you found out that you were getting a bigger refund than you imagined, and you have some extra cash flow, and you can go kind of top off that account, get the rest of it accumulated and contributed for the prior year? That suddenly allows you to maximize the credit. And the beauty of tax credits, as we always say, is it's a dollar for dollar reduction in the amount of tax that you're paying that year. We don't apply credits until we've already calculated the tax bill. And then when a credit is applied, it's just knocking dollars off of the tax bill itself. That's way better than deductions, which just reduce your income and have a trickle-down effect, a partial effect on the tax itself.
Yep. So be opportunistic, be aware. One of the wrinkles with this one, many people were surprised by, is you need to have that 529, at least in Indiana, you need to have the 529 plan open in the calendar year in order to fund it in the spring of the next year. So be aware of that. All right, now to you business owners. And we're talking, small business owners, we're talking side hustles, we're talking entrepreneurs. There's actually, the list expands for you. And one is to fund, you could fund a SEP IRA. What's SEP stand for? Simplified Employee Pension. Don't get confused by that. That sounds, it's another IRA that you get to contribute to based on the profits of your business. This is mostly for those of you that are running a side hustle, okay? Because if you have employees, your SEP contribution needs to be the same for everyone. So in that way, it is sort of like a pension sort of thing. So for most businesses that have a couple employees, doesn't make sense. But if you've got a side hustle and you've got this side income, that actually opens the door, the opportunity for you to contribute to an IRA or traditional IRA and all that fun stuff, but also contribute to a SEP.
I have a longtime client who I consider to be a dear friend after all this time working together. But, he is not only a business owner, but he's also a professional, and I'm referring to his architectural work that he does kind of on the side, mostly for just friends and family, designing a garage addition or something like that. And, he'll most years have a few $1,000s, sometimes even tens of thousands of dollars of fees that he's received in retirement.
Yeah, cool.
And so for him, it's part of his own tax planning to say, well, now that I know the year is over, I've calculated what my actual profit is, what were the business results from this side hustle. Now I know how much I'm allowed to contribute because it's all based on the profit. And he would try to max that thing out each year. You just have more time to be able to do that. And part of it is because you have to first calculate what were those business results. You need some time to be able to pull that part off and then make the contribution after the fact. For him, it really matters some years, though, because his income can get up to that threshold where IRMA becomes an issue on what his Medicare Part B and D premiums are. And so that SEP IRA has saved him some big money at times just by being able to have, we refer to it as kind of an ace up the sleeve, right?
Yeah.
Something you can play after the fact.
And that you have even longer to fund, actually.
Yeah, up until your tax filing deadline.
Yeah.
With
which is not your tax due deadline. So the tax due deadline is April 15th. Your tax filing deadline could be September 15th or October 15th.
So along the lines of the SEP is also profit share for you business owners.
Right. And so that is, and typically, it could be if you've got a 401k, this is a way that in the profit sharing, typically there are some ways to put your thumb on the scale a little bit and favor certain team members over others, but if I'm doing a profit sharing, it's pretty much across the board.
That's equal.
But if it's just you and your wife running the business and it's just you two in the business, then the profit share goes to you too. And so that's where you want to make sure you know what's available to you and take advantage of it.
Another example of a last-minute tax planning opportunity for business owners or those who have a side hustle has to do with the way that you take a tax write-off for major assets or equipment that you purchased during the year. Maybe you bought a truck for your business or a new lawnmower or a piece of machinery of some kind. Well, you get to take a deduction, and it's actually just on paper. It's not even money out of your pocket when you write this off, called depreciation. And the normal game plan is that the depreciation is just a slow writing off of the value of that asset over its useful life. But there are some flexible options within the tax code that let you accelerate that or take a big write-off all at one shot instead of trickling it out over several years. And you get to choose which method you take. And so what a lot of people will do is, again, get the draft of their tax return done, have a sense for where they stand right now if they do nothing and just let normal play out. Or what if you actually take advantage of some of these options and you accelerate the tax write-off? You could bring yourself down into a very different tax bracket. You can make new tools available or new options available from a tax strategy standpoint. There's a lot of multiplying effect that these major decisions can have, and it's somewhat unique to you as a business owner.
Yeah. And so I think that also the default often is give me as much deduction as I can, but if you're ramping up a business or you just brought on a new source of revenue that hasn't really hit stride yet, you might say, I'm only going to take part of this depreciation now and spread the rest of it out. The point is, with all of this, is planning. is planning. And what is that? We defined it at the beginning of the show. It's getting proactive with your tax situation. I get it. I don't like taxes. I can't stand them. I can't stand the tax code. And so part of me just wants to rush, get it over with, and be done with it. But, however, there is an opportunity for you to pause, work with your CFP, someone that's creative, understands these rules, and knows your financial situation and your goals, and says, okay, here's a few choices. Here's a few options for you to consider to improve your tax picture, pay the least amount of tax over your lifetime. Let's figure out which of these you should employ. All right. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Y20 Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.